take the whole class or not. But anyway, so we'll do that one. After class, I'm going to email you just for the journal entries only. From 2 and I'll have this available in Excel, Word, and PDF. And then next week, we're going to do some more of the adjusting entries, and then we're also going to do closing entries. We're going to spend a little more time on this chapter. This chapter actually is very, it's a very important, and it's one of those things that, like, if you don't get this chapter, the rest of them are not going to make as much sense, because you're going to make journal entries for the rest of them. If you don't really have the journal entries down, it just makes it more difficult. So an extra week spent here will probably speed up the class rather than slowing it down. Okay, I've made a decision that I'm going to not use the 2 cameras and writing it by hand. I was looking at my writing and I'm looking at the video and it looks terrible. So I'm going to go back to doing it in either Excel or Word. So I emailed out and it's in Blackboard the assignment in Excel, Word, and PDF. I'm going to show something here. Let me share my screen for a second. Okay. I want to show you something. I know that most of you, if you've been here a while, you already know this. But if you're thinking that you don't have Excel, actually you do. I have a link to it right in the announcements. I just added this. But in the announcement, there's a link to Excel, and if you just click on this, it'll bring up get to Excel, and then ready? And then you can just open, your file, whatever. All right, that. It is. It's also available from your email. If you go into your email account and you click on this checkerboard or whatever you call it thing, you'll see that it has all your applications, and one of them is the Excel. So you can also go, if you're in your email, you can also get to it. Okay, and let me see. I think I already have the assignment in. I do. Okay. All right, so what I'm going to do is I'm going to pull up the Excel version of it. Oh, there's something else I want to talk about. Okay, if you're using either the PDF or the Word document, the chart of accounts is at the end. So we will have a chart of accounts. So this is at the end of the document if you're using the Word or the PDF document. So this chart of accounts here is at the end. Okay. Well, let's go ahead and get started. Okay, been January, so this is 1/1. That's fine. I just one quick question. Is the air conditioner, is that too loud? You guys hear it?
I can't even hear it.
Okay, good. Okay, good. All right. Hey. So it's another good thing about change. I wish Excel wasn't so, all these programs are so helpful. They change it here. Anyway, okay, so all right. Well, what will What would the journal entry be for this one? Issued common stock for 100,000.
It would be cash debit 100,000.
Yep. The cash is going up. No, bull all means. Okay, so cash, it's an asset. It's increasing. You do not have to put this in, but I'm going to put it in. And be 100,000. And what's going to go on the other side?
Common stock.
Yep. Common stock, and now we have more owners. So our ownership is going up. And by the way, if you look over here, you see that what they increase and decrease with. So here we had the so cash rate, common stock. The stuff that we spend money on is going to be a debit, and what and how we get money is going to be credits. So we have cash, which we haven't spent that on yet, but it's our cash is going up. And you'll notice that we can borrow money, we can sell something, or the owners can kick in. In this case, the owners kicked in. But yeah, so it really is just sources go up with a credit, uses go up with a debit. Okay, purchased inventory. It's a journal entry.
Inventory.
Inventory is going up. Now more inventory. It's an asset going up. What's on the other side? Now we didn't pay for it yet.
Not too sure, but maybe an account payable. Also, there was one comment that also said account payable.
Yeah, accounts payable, exactly. So we were actually borrowing money to get this in, right? We haven't paid them yet. Oops. So this is a liability and it's going up. We owe people more now. And again, this is the idea. How do you get stuff in? Well, this is borrowing it. We're borrowing 35,000. So we owe more people. It's going up. Our liabilities are going up. And we did that to get the asset in. This is what we spent the money on. It's the inventory. So this is the use. And this is the resource. That's how we got it. Okay. Paid insurance company, paid an insurance company $2,400 for 1 year policy. Prepaid insurance was debited for the entire amount. Okay, well, that was very helpful of them. They told us exactly what's in debit. And we'll go into why they paid it ahead of time. So it's an asset. We're going to we're going to benefit from for the next year. It's an asset. It's increasing. That's why it's in debit. And what's going to be on the other side?
It's gonna be a cash credit, 2,400.
Yep. Uh, yes, cash. I'm getting all kinds of stuff popping up on my screen. So it's an asset, and this is going down, paying them. We basically just exchange one asset for another. Sorry. So we're exchanging our cash for a prepaid insurance. One goes up, one goes down. Okay, sold inventory and account for 12,000. Okay, so this is a little bit tricky. Let's see. What accounts are we going to use?
Accounts receivable.
Good. Okay, so we're going to have accounts receivable. They owe us. They paid it on account. Hey, we do it. I was underlining. There you go. Okay, so we paid on account. So we haven't got any money back. So this will be accounts payable. Someone owes us money. Oops. I say accounts payable and accounts receivable. So this is an asset going up. We haven't got the money yet, but okay, so they owe us money. Well, what's gonna be on the other side?
Cost of goods sold.
We're gonna have a cost of goods sold. I'm gonna split that up into two different entries. You can put it in the same one though. There's nothing wrong with that. Okay, now cost of goods sold, it's going up and it will be an expense. Now it's gonna be for the 7,000, so I'll put that in. And technically it's a cost, but we'll put it acts the same as an expense. It's actually not cash going out, it's inventory. So whatever we paid 7,000 for this inventory. Okay, so we got the debits. Okay, let's look at the credits. What's gonna be the credit to match up against the accounts receivable?
Inventory, 12,000.
Actually, it's gonna be the inventory will be matched up in the cost of goods sold. I'm gonna put that in. Okay, down here. So inventory will be it's an asset and it's going down. They're when someone buys something, they take it with them, right? So we paid 7,000 for whatever it is that they took with them. And so that's gonna cost, but so we actually didn't pay cash out, we sort of think about paid out inventory, right? I mean, this is all right, so we made a sale, 12,000. They owe us 12,000. The stuff we sold them cost us 7,000. We have to take it out of inventory. We can't sell that inventory again. You only sell it once. What's gonna go up against the other side of accounts receivable? I'll give you a hint. It's on the excuse me. It's on the income statement.
Sales revenue.
Yep. So sales revenue. Oops. It's going up. And I think I've told you guys it's not past, but basically, if you look at these are all the inventory accounts. Scratch that. These are all the income statement accounts. And they go up and they usually almost never go down. So you know, even though we have that they decrease, really look for these, really only looking at the increases. And the reason I say that is whenever you see a revenue, it's a credit. Whenever you see an cost of goods sold or expense, it's a debit. You know, they really don't have some here. These are really not virtually never used unless something weird happens. You pay an expense and the gas company sends you a refund or something, I guess. But for the most part, those are always going to be increasing. Revenues and the expense, those are always going to be, you really don't usually decrease those. So whenever you see a revenue, it's a credit. And 99.99% of the time, that'll be right. Okay. Borrowed money from a bank and signed a note. Principal and interest will be 10% will be repaid in 6 months. Okay. Let's get a date in here. What's going to be the entry for that?
Would it be cash? 30,000 debit?
Yep. Our cash is going up.
And then notes payable
Yep.
for credit?
Oops. No, those. No, it's payable. And so this is a liability. And it's also going up. We now owe $30,000 to, it's a bank, right? Yep, bank. So we got the cash in. How we get the cash? We borrowed the money. So liabilities are sources of money. How do we get, what's the source of money? It's revenues, borrowing money, or the owners can give us money. In this case, we're borrowing. Okay, 20 paid employees, 6,000 for salaries for half of the month. Okay. So we gave them their checks. Oops. What's the journal entry going to be?
Salaries expense?
Yep. Oops. So salary expense and expenses. We see an expense, we say yippee. Well, we don't say yippee as a business person, but as an accountant, we say yippee because we know exactly what it's going to be. It's going to be a debit. These are always debits, basically. They're always increasing. Okay, what's going to be on the other side?
Would it be cash?
An asset going down. So the expense is the use, and we're taking it out of our assets when we pay with an asset. Is that one of these? Solar inventory? Oh, no, this is different. A little bit different on this one. Similar, but different. We sold the inventory for cash. So they paid us right away. So what accounts are we gonna use?
Will it be cash for 10,000 debit?
Yep. So cash is an asset. What are you doing? It's just as bad as me writing, you know. As it turns out, it's not the pencil's fault. All right, so this is 10,000. All right, and what other accounts are we gonna use?
We'll lose inventory, so inventory credit 10,000.
Yep. And we'll put that separately. You can put it together, it doesn't matter. Inventory is an asset, it's going down. And it will be, as you said, a credit for 6,000. Okay, now so that takes care of our asset accounts. Now we have to go, those are on the balance sheet. So now we have to go to the income statement. What income statement accounts are we?
Would it be sales revenue?
Yep. And again, sales revenue, whenever you see revenue, you say yippee because you know exactly what it is. It's going to be a credit. The inventory one is not as obvious, but we still need to put it in, obviously. Now, this inventory is gone, right? We can't sell it again. It's gone. So this is kind of like an asset going. It's not cash going out the door, but it's inventory. Whoever bought this took it with them. What account are we going to use? And
Cost of goods sold. Right.
yep, it's going to be amongst these, and these are the income statement accounts. And yes, cost of goods sold, and it's similar to an expense, except that it's instead of paying cash out, we gave out inventory. Cost of goods sold. 6,000 and no longer happening. One thing you know about these income statement accounts, and you'll notice that these are called nominal accounts over here, and we'll talk about that in a bit, but they're kind of just counters. They count what's coming in and what's going out. You know, they're not actually the cash, they count the cash coming in. You know, they're not actually the inventory, they count the inventory going out. So it's sort of like keeping track of what came in and what went out. And hopefully what comes in is more than one. So in this case it is. Okay, paid 15,000 to suppliers for the inventory purchased on January 2nd. I'm gonna go up to January 2nd just so I can see what that is. Inventory accounts payable. Okay, we paid 35,000, so we're gonna pay part of it, looks like. Okay, so what will this account look like? Let's take the easy one. What do we pay them with?
Cash.
Cash. So cash, it's an asset. Oops, here. Cash is an asset. It's going down. We credit. You do this. I did. You don't have to put that asset minus thing. It's just me keeping track. Kind of showing you how I got it. All right, what's gonna be on the other side? Anyone? It's
That'd
not,
be accounts payable.
yes, good. You know, it's tempted to say, oh, that's for inventory. We've actually already counted the inventory up here. We got 35,000 of inventory. So we don't want to count the inventory again. But now this accounts payable says that we owe 35,000. Well, we don't owe 35,000 anymore. We just paid off 15,000. So this accounts payable is going to go down with a debit. So there's a liability. It's going down. We owe them less now. We just paid them 15,000. So we owe like what, 20,000 still. 26, collected 6,000 on accounts from customers. I assume these were the customers. Numbers 10. Sold to them on account, so 12,000. They sent us about half of it. Okay, so what's the journal entry for that gonna look like?
Would this
It's
be
gonna be
accounts
cash.
receivable?
Oh, sorry.
Yep, yep. Yeah, yes and yes. So they have to be cash is going up. For 6,000. And now notice that they don't owe us as much, right? So this, you know, this accounts receivable, they don't owe us 12,000 anymore. We have to take out 6,000. So accounts receivable will go down by 6,000. Oops. So this is kind of just exchanging one for the other, although anyone in business will tell you you'd rather have the cash than the accounts receivable. So our cash goes up. They no longer owe us for 6,000. I think they still owe us another 6,000, but we got half of it. Okay, on the 28th. We paid $1,000 to a local utility company for January gas and electricity.
Should be a utilities expense debit.
Yep. Utility expense, that's a use of the cash, and expenses are always. Unless the gas company sends us a check, it's gonna be a debit. All right, what's gonna go on the other side?
Gonna be cash.
Cash, it's an asset, it's going down, we have to pay them. 1,000. And notice that the cash is what's going out. This utilities expense account is really just counting what went out. You know, it says, okay, 1,000 went out for utilities. It's really just counting what the cash that went out. Paid 4,000 rent for the building. $2,000 was for January rent and 2,000 was for February. Okay, so we paid 2 months. Prepaid rent and expenses were debited for their appropriate amounts. Okay, so we could split this up into two. I think we're going to split it up into, let's see, it is one. Okay, we paid them $4,000. What do we pay them with?
Cash.
Cash. So we just paid them $4,000. And they said that it was 2,000 for each, so January rent and February rent for prepaid and rent expense. Okay, so, well, they just go toast to accounts. Okay, so let's take what the first one they said was. How strange, they have the January 1st, which would be expense, and then they do the prepaid, which would be the February. Yeah. Okay, so let's take the January 1st. So rent expense. Oops. I'll put in this is for January. And so that is 2,000. It does put in prepaid, which is correct. It's an asset. We're not going to use this asset until next month. This is for the February. And this is an asset going up. Someone owes us a month of rent, basically. So the January is going to be an expense. It's for this period. The other 2,000 will be for next period. Now, this is all that they have in the problem, the original problem. What I'd like to do, though, is for us to go over what the adjusting entries for this would be, because they don't ask us to do the adjusting entries, but there are some here that we would be doing. Now, adjusting entries are when you adjust your books to what is what should be allocated to that period. And the first one I'm going to look at is the prepaid insurance. Okay, so it's prepaid insurance. It's for 1 year insurance policy. Okay. And prepaid insurance is debited for the entire amount. That's fine. Okay, so it's $2,400 for a 1 year insurance policy. 1 year is how many months?
12.
Okay, so how much of this insurance do we have to recognize? Okay, so the prepaid insurance was for, I might. I'll see if it's in here. Oh, I wonder if I could merge these. Hey, I was not letting me merge them. Okay, so the prepaid would be for $2,400. And that's for 12 months. So how much would it be per month?
200.
Yep. Hey, it worked. Okay. So the prepaid is $200 per month. Okay, so what are we going to do with this? First of all, we've used up 200 of this asset of prepaid rent. I'm going to move this whole thing down. I'm going to move it back up. Isn't this fun? All right. All right. So the prepaid in, what is it, prepaid insurance? So prepaid insurance, we have 2,400. We really don't have 2,400 though in that account anymore. How are we gonna adjust for the 1 month worth of insurance? What do we have to do?
Would our cash go down by 200 credit?
Actually, not our cash, but close. We already paid the cash up here.
Would it be an insurance expense?
Yes, you'd have an insurance expense for 400. No, that's right. 200. So let's be insurance expense. Expenses are always debits, 200. Now, our prepaid account, again, we have $200, excuse me, $2,400 sitting in this prepaid, but it really isn't $2,400 in there anymore. We just expense 200 of them. So what are we gonna do with the prepaid?
Prepaid get credited 200.
Yeah, so our prepaid insurance. It's an asset and it's going down. So we have this on our books as an asset, but we really don't have 12 months anymore. We only have 11, so we're gonna take out 1 month's worth of it. So we're gonna take out 200 out of this prepaid insurance. And again, we don't want to overstate our assets. We don't want to say we have more assets than we really have because, we really don't have 2,400 prepaid anymore. We only have what, 2,200 things. Now, notice that there's no transaction for this. It isn't like we got, something in the mail that says, hey, adjust your prepaid insurance. So adjusting entries are not necessarily obvious. And for that reason, yep. And so for that reason, they are oftentimes, oops. There is, you don't get a, if you have a rent expense, okay, you got the lease, they hand a lease in front of you, and you see the document, okay, I gotta pay this, and you pay it. There is no document that comes in for adjusting entries. The insurance company doesn't care how we keep our books. They got their $2,400, they're gonna insure us for a year, and whatever we do with it, they don't care. They just have bad attitudes. But anyway, so adjusting entries are not obvious, and because of that, sometimes they get missed. And so if you're an auditor, you always look to see if all these adjusting entries are actually being put in, because it would misstate their income. If we didn't put that $200 of expense in, our income would be misstated by $200. Okay. This one is another tricky one. These will all be at the end of the period. Adjusting entry for the notes payable. Okay, let's take a look at this. Here it is. So we have 30,000 note payable and 10% interest. Okay, coming down here. Okay, so we had a notes payable, so it's 30,000. And it's at I think it was 6%. It's 6%. It's at 10%. That was me just testing you guys to see if you're paying attention. 10%, and it's for 6 months. Now that 10% is for the entire year. Percentages are always given in annual amounts required by law. So this is per year. So this is per year. This is per year. Okay, so it's 10% per year. we only have this for 6 months. We actually don't need to worry about that right now. But here's the question, how much time has gone by between when we got this? So we got this on January 15th. Okay, so how much do we need to expense that we owe on this note right now? We've had it for what, half a month? So let's come down here. We had it for half a month. I put this in the wrong spot. I goofed up my. Okay, so. Let's figure out how much do we owe them every month? What's the interest every month? I'm gonna insert a row here. So we have 30,000 that we owe them. Is that 10% times 0.10? And a couple different ways we could do it. If you want to just get it into the monthly amount, I would just say divide by 12. Wait a minute, I'm in Excel. Why am I doing this by hand? Okay, so 30,000. Times 10%. So this would be 3,000 per year. Divide by 12. So this would be per month. So we're going to expense $250 per month. Okay, so it's $250 per month. We've had this for half a month. What's going on here? Here we go. So this equals $250 per month. If we had this for half a month, how much do we owe them?
125.
Yep. So okay, so I'm going to Ireland. Okay, so let's come up here. I don't have. Oh, here it is. I'm sorry. We're gonna have interest expense. And expenses are always debits. What's going on the other side? So we owe them $125 of interest right now. What kind of account is it when you owe somebody?
Account payable.
Yep. In this case, we're probably gonna call it, you could put it as accounts payable. We're gonna put it as interest payable. So I'm gonna put this as interest payable. It's a liability going up. We owe them $125 now. And so that would be the adjusting entry. And again, you're not gonna get a notification to do this. You know, the bank doesn't care how you do it. It's kind of wonky. I'm gonna do something. Okay. So we owe them 125. We're gonna have interest expense of 125. And we're gonna have a liability of 125. Okay, salaries payable. This is another one of those things that, you know, no one's gonna. Notice that the employees are paid, says first half of the month, so probably like 5 days after the, 15th or whatever, 16th or whatever it is. So they get paid after they've, they work, and it takes 4 or 5 days to get their paycheck. Well, okay, so at 12/31, you're not gonna have employees knocking on your door saying, where's my money? However, we still owe them for that half a month. Okay, so this is again 131. All right. What's going to be the journal entry for that? So we owe our employees $6,000. Well, let's take the easy. Salaries payable. We owe them more money now, right? So salaries payable. Owe them. We owe them $6,000. Oh, wait, we do something here. This is a salaries payable is a liability and it's going up. We now owe them more money. What's going on the other side? Anyone?
Is that a salaries expense?
Yep. Yeah, so our salaries expense for the period, what we owe, we owe this to the employees. We used 6,000 of their labor. See their salaries, their brains, for 6,000. So this will be our salaries expense. And again, this is one of those things that no one's going to tell you to do this, but you have to know to do it to adjust your book so that you accurately show how much actually you used up of this, for instance, the employees' work for the month. So these last three, these are adjusting entries. they are a couple things. They are actually maybe a little bit more, say dangerous, but they're more easily overlooked because you're not going to have anything, you're not going to have a bill in the mail that says make this journal entry. But you have to know to adjust those so that you don't put accurate amounts. Okay, let's stop here and let's take a break and we'll come back and fill out the rest of them. So let's see, be back at, yeah, okay, be back. 301. Okay. Hello. So we just made the journal entries. Now, and one thing I want to tell you is about kind of how larger companies work. In a small company, if you were the account, you'd make these journal entries and they go right in. You know, you could put them right into the system. Larger companies, they usually they'll have staff accountants that make journal entries. Those journal entries, before they go into the system, will be sent to an accounting manager who will approve them. So for instance, if you're working at Ford, you make these journal entries, it's going to go to an accounting manager. An accounting manager will look over the journal entries before they enter into the system. They don't want to just have anybody putting in entries. So the accounting manager will take a look at it, and as you move up, maybe will become an accounting manager. You'd be looking over these journal entries. So before they actually go into the system, they'll have this big list, and before they go into the system, they'll go to the accounting manager, and then the accounting manager will approve them, and they'll call this posting into the general ledger. Okay, so we have to put them into our general ledger over here. Now, flipping between these two would probably be less than fun. So being lazy, I'm going to copy all these. Copy. Come over here and I'm going to paste them here. Paste. The dates, I don't care about the dates. We just need the accounts. So what we're going to do, put a few here. Yeah, we adjust these. Okay, so let's go up here. So all we're going to do is take these and do what they call posting these into the accounts. Okay, so take the first one. Cash, 100,000. That one's back, 100,000. Be careful on the debits and credits. Purchased inventory anyhow, so inventory, asset, 1,000. Accounts payable. Prepaid insurance, an asset for 2,400. Oops. He's bolded. Okay. And cash is going down by 2,400. To make these stand out a little more. Ooh, look at that. Look how much better those look. Here you guys thought I was just showing you stupid stuff. There's no accounting, but those ledgers look fantastic. Okay. All right, so let's take a look here. Okay, so let's keep going down here. Sold inventory and account. Okay, so this will be accounts receivable, 12,000. Sales revenue. Credit, 12,000. You should get the debits and credits right. Maybe double check, okay. Cost of goods sold, 7,000. Good. Inventory. Second, inventory, 7,000. Let me. You know what, I'm just gonna move these up. Come on. Get these back up where we need them. Oh, come on, stop it. What are you doing? Why are you doing this? Something weird happened here. Let's try this again. I'm gonna copy this. Let's be copied. All right. So here we go. Cash and notes payable. So cash is 30,000. And notes payable is 30,000. Salaries expenses 6,000. And cash is 6,000. Okay. So one of these. Cash is 10,000. And sales revenue is 10,000. Cost of goods sold is 6,000. No, I'll put these up here in a minute. You can see all of them. You take screenshots if you want. And inventory is going down by 6,000. Accounts payable is debited by 15,000. Cash is credited, going down by 15,000. Push my luck again and try this again. Okay, let's see here. Yeah, there's a lot of these. Wait a minute. Some of these are duplicates. I did something wrong. Don't do that. Come on, what are you doing then? Wish it wasn't so helpful. Copy. Don't you let me know. Okay. Let's see, elected 6,000. Accounts receivable. Went down by 6,000. Cash went down by 1,000. And expense is a debit for 1,000. Cash is a credit for 4,000. Expense is a debit for 2,000. And prepaid rent is a debit for 2,000. Okay, adjusting entries, insurance expense, 200. Let's see. Oh, here it is. Debit for 200. Prepaid insurance is gonna go down by 200. Interest expense and interest payable 125, so interest expense is 125. Debit. And interest payable is 125 credit. And last, certainly not least, is salaries expense. 6,000. Oops. 6,000 debit. And salaries payable 6,000. Okay. Well. Two, three, four, five, six. Two, three, 32, 33. Okay, we should have 33 entries in here. 9, 11, 14, 15, 16. I see 33. You are asleep, aren't you? All right. I'm gonna go ahead and start adding these up. I should ask, does anyone see any glaring errors? Okay, so in cash, we have. $146 and 28,400. So this would be our, we don't need any of this anymore. Okay, thank you. All right, so this will be, let's make we use that on orange. Okay. Accounts receivable. They owed us 12, they paid us 6, they still owe us 6. Okay, so this one over here will be some. Two. By the way, if you're wondering why we didn't actually have to do any adjusting entries for the prepaid rent, it was because of prepaid rent, they already figured out. That's kind of like the adjusting entry right there. It's already done. They already split it up between the 2 months, so we don't have to worry about that one. So if you're wondering why, we did adjusting for the prepaid insurance, but not the prepaid rent, they already did it. Okay, so this will be that. And again, the biggest side always wins. So we still owe 20,000. Maybe just onesies here. You're gonna lose money, which wouldn't be unusual for a first month in business. Okay. One thing you can always check too, just to make sure you're kind of on the right track. It is, let me do something here. I want to show you something about this.
I'm sorry, I have a quick question.
Yeah.
Could you explain again why we only have one 2,000 for prepaid rent? Will it be because I know for journal entry 30 we had rent expense for January and February. So would we put 2,000s over there?
Yeah, there's a rent expense and a prepaid. We split it up, the 4,000. That's a good question.
Oh, okay.
Yeah, so there's 4,000 total. Second. Now, if they were to put this all into, say, prepaid rent, we would have had to do an adjusting entry. Or if they put it all into rent expense, they could have done that way too. We would have to do adjusting. But because they've already split it up, they said, okay, half is for one, half is for the other. Okay, now next month, we're gonna have to take it out of prepaid rent and put it into rent expense. So this 2,000, for the prepaid, this 2,000 prepaid rent next month, we will credit that. And it'll be another rent expense for the other 2,000. So the rent expense will be 2,000 for each month.
All right, that makes sense. Thank you.
Okay, now I want to show you something about what they call real accounts on the, and this is actually true for all of these, but generally those things that increase are going to be the ending balances. So cash and accounts receivable, all these assets, these should all end in debits. You know, if you think about it, like for instance, we could have zero cash, we couldn't have negative cash. We could have zero inventory, but we can't have negative inventory. So wherever you see these increase, this should be the normal balance. And same thing like with the liabilities. You know, they should all be credits. You could have zero accounts payable, but you can't have negative, those payable, those other things. You could have zero of those, none of it, but you wouldn't have negative. So these, if they do have a balance, they're going to be where you'd see the increase. You know, and same thing here. Wherever you see the increase, this will be the normal balance. So we do something. So the increase is the normal balance you would have. So is the normal balance. I will clean that up a little bit. And so increase is going to be the normal balance for all these accounts. And again, it has got, you could have zero sales, you can't have negative sales, so on and so forth. So wherever you see the increase, it would be the normal balance of these. So if you do come across an account that is, say you have a revenue account that's showing a debit balance, that's not right. You back and look at it. But the normal balance, wherever the increases will be, that'll be the normal balance. Okay. Now, the trial balance. Flipping between these two, I guess it wouldn't be that bad. It wouldn't be that bad, but again, I'm trying to teach you guys how to be lazy like me. So, according to, you'll cut and paste. I'm going to cut and paste the trial balance over here. We'll pay it. I'll paste it back. I'm just getting it on the same sheet just so it's. Let's see what I can copy. Okay. All right. So I'll do it. Do it here. I'll do it here. Okay. So what I'm going to do is kind of fill it in here on the same sheet so that we can. I'm going to be more lazy. Look at this. I'm going to put. This is kind of dangerous to do, but that's me. I'm a dangerous accounting guy. Oops. See, being dangerous isn't so good. I did something wrong here. Prepaid insurance is this. Prepaid rent is that. Okay. Let's pay up on. Oops, oops, oops. You can see right here, they're gonna lose money. Their sales coming in was 22,000. We're already at 25,000. It's not uncommon for a first month in business. Now, hopefully. Cross your fingers. Oops. Oh, it does match. It's in the wrong spot, but it does match. Yay. Formatting is different, but it's the same. Okay, so this is. Now, here's the thing. These are formulas, so if you're going to cut and paste these, you got to paste them as values. I'm going to copy these over to the trial balance now. Double check, cash, okay. Now, when I paste these, I'm going to paste as paste special and values. I don't, if I put it in the formula, well, I'll put it in the formula. See, it says, hey, you're Mark, you're stupid. You don't get personal about it. Okay, so what I'm going to do here is I'm going to paste special and values. The formatting got a little messed up, but I'm not going to lose too much money, a little bit of money. And again, first month in business is not uncommon. Okay, financial statements. To do the financial statements, really don't need to know the debits and credits. I guess I'll put it in just for yucks, but you really don't need it. Okay. Let's do all the income statement stuff together. Oops. No, let's make it, I don't know. No. Okay. So we'll make all the income statement stuff then. So copy paste if you want. So sales revenue coming in, the cost of goods sold is what's going out. I'm going to put that in as a negative because this is actually something that's leaving the place. Maybe I should move that up. And this will give us our gross margin or gross profit. I can't remember what I said last class, what did I call it? Gross margin, it doesn't matter. They're the same thing. Gross margin or gross profit, so whatever that is. So our gross margin is 9,000. Now we have our expenses. Here. I don't do. You're wondering, is there an easy way to do that? Yeah, it would have been easier to do this with formulas. Oh, don't do that.
Is it possible for net income to be a zero? Or I mean a negative, or would it just be
Yeah.
zero?
Yeah, so this would be net income. In this case, it's gonna be a loss. So if it's negative, it'll be a loss. In this case, it's gonna be a negative. So 9,000. We already have 12,000 salary expense, so we know this is gonna be negative. Again, the first, so they have 6,000. It's usually expected for a first to start a business. Usually expect to take a few hits, the first year. It's kind of rare to have a business that starts right out making money. Okay, so that is our income statement. See, retained earnings, our beginning retained earnings. Well, this is our first month, so we don't have any, but we'll put it in beginning. Zero. Our net income or loss. Negative 63256. I should actually I should make it. I don't trust myself. Okay, dividends paid, none. And actually, in this case, they couldn't have paid dividends because they have anything in the piggy bank. So our ending retained earnings. Would just be our loss. Let's make that. Let's make that blue because we're sad about the loss. Let's see. No, no. Okay. And this is just the okay. Oh yeah, I forget. I don't know why the default color is that light blue. Can't see it for the arrows. Okay, let's go to our assets. I think these are all current assets. We don't have any property, plant, and equipment, so all of these are going to be the assets. Let's color all these some different color. Oh, wait, no, blue. Actually, blue is a good color to color that because this retained earnings actually will come down into. Okay. So let's do all these, copy. See how lazy I am? You could be this lazy. You gotta apply yourself though. All right, so there's our, I think that's all of our assets. 12 the assets right now. Oops, don't do that. Okay. Oh, I see what it's doing. I know. Look at this all tricking. Auto sum, man. I'm tricking you. I know I'm sure. Yeah. Okay, so let's go to liabilities. Liabilities. We don't have any long-term liabilities. The notes payable, I think, is only 6 months, so that's not going to be long-term. Okay, stockholders' equity. We'll have the common stock. And we'll have the owner's piggy bank, which right now is not helping them. They actually have negative in piggy bank. And until they get that into positive numbers, they can't take any money out. Oh, I see what I did. Okay. Well, I'm going to add these up individually. $149,800, yay, that is a balance. Yep. Oh. That would be it. Okay, I'm gonna go back. I'll let you guys get screenshots of this. You don't need this to make them. So there's our income statement, the statement of retained earnings, and the balance sheet. This income statement, when we start the new, we start the new period, we'll cancel, we'll actually wipe those out. And the balance sheet. So these accounts will all stick around. You know, our cash will still be there, our accounts receivable, our inventory will still be there. These counters, these are just counting money coming in and out. In this case, it counted that we had more money going out that came in. But these are just counters. We'll zero those out and start into the next, well, I guess next month. So February, we would start a brand new month if we were closing this in February. Or at the end of January, we close this out and start February and start at zero for all of those. Most companies wait till the end of the year to close them out, but you can do monthly closings too. Okay, trial balance, you gonna get a picture of that, a screenshot? General ledger, give me 1 second. Did everything? You don't need this. It's kind of small. If you want, we can do this in two, I guess. Detail. Wow. Okay, so there's 1/2 of the ledger. And there's the other half of the ledger. Fun accounting fact, they call it a ledger because it used to be a great big giant book. They don't want it on their desk, so they put it on the window ledge. So it's called a ledger. Journal entries, which, you know, we don't really write journals anymore. You know, we also have ledgers. We really don't set big books on the ledge of a window anymore, but we still have those names. Okay, and probably the most, say difficult, but the most, I will say journal entries. So I think these in chunks. 1 through 4. I get a screenshot of that. Ten through 20. Screenshot of that. Twenty-two through 26. You know, I should make these more. I should put something in here so we can see. Yeah, you know, it sounds silly, but it really does help to see the rules. You put a colored background that's gonna break it up. That'll be for future improvements. 28. The first adjusting entry. Accounting, when you hear people complain about the end of the month closings and stuff, part of the reason they're saying that is because you have to do this kind of thing, you know, figuring out how much applies to this period. Sometimes some systems will automate it, some things you can't really automate. You gotta. What are you doing here? Okay. Well, actually, there's all the adjusting entries together.
Could you go back down to the balance sheet really quickly?
Yes.
Thank you.
I tell you what, let me zoom in on these. And I'll go to the top of it. So there's the balance sheet. And again, make sure that you have this one as a negative because it's yes. The owners lost 6,325. Probably were expecting it. And then let me go up to this, if you need this one. So these are the income statement. I can't remember in the accounting 210, if we call the gross margin or gross profit, they're the same thing. Yeah, and generally speaking, the retained earnings, I think I mentioned last time, are kind of like the piggy bank. And if there's no income in, you can't pay any money out generally. So, you can't pay dividends out of an empty, in fact, a negative piggy bank until this gets up to positive. Generally, you can't pay out dividends. I'll tell you something else that's kind of interesting, though, that you'll hear sometimes. Sometimes you hear about a company going through restructuring, right? It's like, okay, we're going to restructure the company. We'll restructure the company. You say, well, what does that do? One of the things that they do when they restructure a lot of times companies that are being restructured have a bunch of losses. So they have retained earnings that are negative. Now, investors know if it's negative, you're not going to get a dividend. Even if the company starts doing well, you might have millions, if not billions, in these negative retained earnings. So when they do a restructure, what they'll do is they'll wipe out the negative retained earnings and they'll wipe it out of your shareholders' equity. They would, if they were going to wipe this out, they would say, okay, 100,000 minus this, whatever's left over, and we'll strike out, put those retained earnings back to zero. The reason you do that is that possibly more investors will invest in it because now they have the possibility of getting dividends. Whereas, if the company has huge losses for many years, there's no way they're going to have dividends paid out. So that's what a restructuring is oftentimes for a company going into bankruptcy or coming out of bankruptcy. The courts will allow them to reset these retained earnings to zero and kind of start over. Okay, any questions? Anyone else need to see anything? Okay, well, we can turn that one in. Let's see. And I'm going to send out another one. It's just going to be, we'll just do the journal entries for it. And don't be afraid to make a mistake. We're all friends here. I'm going to I'll put the correct answers up. You can kind of take a look and we can talk about them, whatever. But I'm going to send out, so this be journal entries. This is for problem 2-2. It'll be similar to what we just had, except we're not going to do the general ledger and the trial balance and the financial statements. I just want to get us to get more practice in doing the journal entries. And then next class, we're going to do more on the adjusting entries and then the closing entries. And again, part of the reason the adjusting entries are actually, I know we teach those in accounting 210. I really don't think we should. They're pretty difficult. We will not be doing reversing entries. Reversing entries are simply a bookkeeping trick that really probably isn't used anymore. And the reason I say that is the accounting software will automatically adjust things for year ends and all that. It used to be it was a bookkeeping trick to allow for people who are bookkeepers to do the exact same entry, and you would make the adjustments at the end of the year, like we just did, the adjusting entries, and then you would reverse those adjusting entries so that they would start out with negative balances and all this kind of stuff, because when the people put in the full amount, it would automatically adjust. it's a bookkeeping trick. It has nothing to do really with accounting, and I don't think they've ever tested that on the CPA exam. They may have tested something like what is it, but as far as actually doing reversing entries, it's not required, and you can just make regular journal entries. You don't need to do reversing entries. So we're not going to cover that. And I like to say, I think that that's kind of an archaic hangover from when we used to do all this by hand, and you had clerks that were basically people who graduated from high school. You know, when they go into a company, they become a clerk. You graduate from high school. You didn't graduate from high school, they put you on the assembly line. If you did graduate, well, you get to work in the office, and you know, you made the same journal entry every single time for whatever it was you were doing. So anyway, so I'll send that out. I actually have it pretty much ready to go. I want to check it just to make sure that it's on the up and up. But I should have that out probably in the next, let's say hour or two. Hopefully it'll be less than that. But I'll go ahead and send that, and I'll put the in the assignment thing. And if you want to, because it won't be due until the 12th, you can actually wait till class to turn it in if you want. Or if you turn it in and you have something wrong, you can always just turn in the new one, and I'll go right to the new one. You can submit things multiple times. Any questions?
Wait, so I had a quick question. So you're saying, so this is due the 12th, or there's another assignment after this one that you're going to release in like an hour or two?
They'll both be due on the 12th. What happened there? Yeah, so this is the one from last week is due on the 5th. Most of you guys have this already. So this is the one for today, and I'll put another one in, and it'll be due for Friday the 12th. But you can ask questions if you. And I think I told you this before. If you turn them in late, there's nothing wrong with it either. But by next class, we'll go over it, make sure that everyone has it. I just want to have you try it on your own. And again, don't be afraid. You guys can't see what I'm doing. I'm an idiot. Okay. That was the evil Mark talking. We're not showing you guys what's going on. Okay, so this is the stuff from last week. This is what we just did. So these can be turned. This can be turned in here. And there'll be another one. It'll be 2-2, and it'll only be the journal entries. And give them a shot. Don't be afraid. And if you do make a mistake, that's really good. There was a famous race car driver. He's actually still around. Nicky Lauda. He actually owns an airline, Lauda Airlines. But one of his favorite quotes, or famous quotes, was, "You learn absolutely nothing from success. The only things you learn from mistakes. So if you make a mistake, you say, 'Good, I just learned.' And when you make a mistake, you don't do it again. If you do something right, you don't examine it. But if you do something wrong, you examine it. Okay, so yeah, I'll send it out. And again, if you need more time, we'll see if people want more time on it next. I don't mind backing it up to the 7th. No, 19th. That'd be fine too. And hopefully by next week, though, we'll be ready to. We'll send out the exam. We'll plan on next week me sending out the exams for chapter 2. And those will be due in whatever 8 days from next week, or the 19th. Yeah, so next week we'll really do more of the adjusting entries and then do the closings. And the closings aren't too bad. Yeah. Okay. All right, any questions? Okay, so I will send that out shortly, and it'll be in all 3 formats, so whichever one you want to use is fine. And that's what's leaving. Okay, well, any other questions? Okay, 4 minutes early. Woohoo! Well, don't go too crazy with that extra 4 minutes, but I will see you guys next week.
Thank you. Have a good one. Bye bye.
Have a good one.
Yeah. Bye.